Okay, welcome to a quick tutorial here in Excel for our extra credit exercises. I'm going to do 4 different exercises this week and not put them all together, so you can grab the file that you want. So what we have here is, boy, it couldn't be simpler. And I'm not going to spend as much time on the theory of it because you've got that in other places, but I'll just quickly remind you what we're doing here. We're understanding the profit margin and the return on assets, how they're calculated, number one. And then number two, we want to understand when we change cost of goods sold, what happens to our asset base and what happens to our profit margin. And last, we're going to look at the effect of basically how much earnings increase do we need in order to get the same result as a reduction in cost of goods sold, right? So how hard does sales have to work to earn the same amount of profit as a reduction of 10% in this example? Okay, so let's look at that real quick. So profit margin, you will recall from your finance class, if you've had it, is simply our earnings divided by our sales or revenue, whichever you want to call it. Sales, revenue, it's the same cat. Okay, so we can just go in here and simply say equals our profit / is divided by our revenue. Profits divided by revenue. 10%, $5 million in earnings, in profit, and $50 million in revenue. 10%, nice and simple, right? Our return on assets is from the balance sheet, right? So earnings, right? The earnings statement comes out of the income statement. And we basically are looking at what have we sold and what did it cost and what was left for us, our pre-tax earnings. The balance sheet is tracking our assets and our liabilities, our owner's equity, and it's just a snapshot in time that says this is what we have. Cash, accounts payable, accounts receivable, inventory, property, debt, you name it. All of that structure of our assets and our debts is all on the balance sheet. One of the items on the balance sheet, importantly, is affected by what we pay for our material because it ends up being our inventory valuation. So if we have, in this case, $2.5 million worth of inventory in our warehouse, well, the less we pay for our materials, the less of our money is tied up in that inventory, right? So our asset base goes down when we pay less for those things. So there's an effect of cost of goods sold reduction on the income statement. It's going to change this 10% because we're going to have higher earnings. And on this return on assets key ratio because we'll have higher earnings and lower inventory. All right, so let's finish clicking through here to calculate our as is return on assets. So into this box, and that equals our earnings, the $5 million, the return, right, our earnings, divided by our total assets. And it returns 63%. We have a 10% profit margin and a 63% return on assets with the business as it is, right? And the boss or somebody's saying, hey, let's model out what would happen if we had a 10% reduction in our cost of goods sold. That's our purchased material, right? Our cost of goods sold. Translation is we want to pay our supplier 10% less. There's going to be a little negotiation involved, I would guess, wouldn't you? So, but anyway, we want to model it out and see how it would look. So as you recall, we had $30 million in cost of goods sold, right? That's what we're currently paying. We want to model this with 27 because that is 90% or 10% less than that. So equals F10, right? Our 30 million times 0.9 to $27 million. And the key principle to remember here is that we have just taken in this model $3 million out of our supplier's pockets and put it in ours. That's $3 million we would never pay the supplier for exactly the same amount of materials that we used to pay them $30 million. Now we will pay them $27 million. For that reason, we need to add this $3 million back into our profits, right? Because it won't show up as cost. So we're just modeling this in short form and saying we'll add that into the profitability for this what-if model. So we would add in the $3 million, and we would see that our $5 million from the current situation would become $8 million if we were successful in negotiating this reduction with our supplier. Okay, so we know we're going to have a different profit margin, right, when we do the math here in a second. We're also going to have a different return on assets. For one reason, because the profit margin is the top, the numerator in that return on assets, but also because we're playing with the value of the inventory. So our merchandise inventory, as we are today, is $2.5 million, but we're going to reduce our price by 10% that we pay for that inventory. So the value of the inventory is less. We're not going to pay for as much for it, and we won't be able to value it as if we did. Right? It'll be valued at what we really pay for it. So that would be 2.250, which is simply $2.5 million minus 10%, which is $250,000, right? And we take that out of there. So the new merchandise inventory is 2.250, and if we make an adjustment then in our total assets by eliminating $250,000 from our total assets, the $8 million, we'll see that our new total assets is $7.750 million. Hopefully you followed that. If not, that's why it's in a short video. You can rewind it by about 30 seconds and catch it again. Okay, so let's run our new ratios. This is going to equal our profitability of $8 million, our new profitability, divided by our stable $50 million in revenue. Our profitability went from 10% to 16% when we reduced the cost of sales by 10%. Okay. Our return on assets is now $8 million as the profit number on the top part of the ratio. Let's put an equal sign in there. $8 million / is divided by our new lower net total assets. Right, they're $250,000 lower than they used to be. Hit return. You see that our new return on assets is 103%. So you can see a couple of key ratios there that are important to any business. Profitability, yeah, and return on assets is a very important ratio as well, because nobody wants to have more assets than they need, and everybody wants a good return on their assets. It's a big part of the investment of most firms. Okay, so the other thing that we want to have here in this spreadsheet is to just quickly understand the concept that a dollar saved off of our cost of goods sold gives us a certain profit, the whole dollar, right? And to be able to use the profit leverage effect to understand how that's not true, but there's a different calculation to find out how much sales would we need to generate to earn that same amount of money. And it's simply a function of the profit ratio, right? It's simply a function of the profit ratio. And I'll show you why. Okay, we're gonna put $1 in here. All right, so we'll find out for $1, how much sales do we need to generate to earn $1? Well, that simply is the division of that dollar by the profit ratio. 10% is our profit ratio, right? So if we don't change the business and get that cost reduction, let's say hypothetically the company was trying to have purchasing save that money because we need to hit these number, this additional $3 million in profit is needed. Well, purchasing made a run at it, and all our suppliers told them to pound sand. So now we're not going to get it out of the supply base, and we're looking at sales and saying, how much revenue do we need to generate to earn that $3 million? Well, it's a function of this profitability ratio at 10%. So there it is, and it's maybe almost too even of numbers because I hope you catch what's going on here. The 1, the 10, and the 10%, I hope it doesn't throw you off because it's too rounded. But what we're saying is for $1 in profits, because our profit ratio is 10%, we need $10 in sales, right? So it's simply 1 divided by the profit margin tells us this number. This $10. We need $10 in sales to earn $1 in profits. And once we know the $10, it's easier for us to say, okay, and what was the target, gang? You want to earn $3 million? All right, well, let me tell you. If you want to earn $3 million, all I have to do is multiply my, here, we'll put it in this box here, equals our amount we need for each dollar, right? Our $10 times the amount you want to earn. And we would have to sell $30 million to earn $3 million at a 10% profit margin. You can test this to, sometimes it's fun to play with it a little bit, and that's one of the beauties of Excel. We could say, what if, and sometimes when you do this, it helps you see the relationship a little better. Let's say our profit margin is 5%. Watch what happens to the numbers. Oh, now we got to sell $60 million, right? It's a lower profit margin. Now I'm only getting $20. It takes me $20 in revenue to earn $1, right? What if our profit margin was 2%? Now I got to sell $150 million to get that $3 million in profit. And I got to sell $50 to earn $1 in profit. What if our profit margin was 20%? Well, now every time I sell $5, I earn $1. And to earn $3 million, I only need to sell $15 million. So you see how this works. At a given margin, we'll go back to what the story was. At 10%, we can calculate, using the profit leverage effect concept, we can basically calculate what it would take to do any amount of earnings, as long as we know what the profit ratio is, so that we can apply it. I hope you enjoyed that. We're going to do the other parts of the Excel Extra Credit in separate videos so that you don't have to dig into a big, long video to find maybe a little part that you needed. Okay, so we're all set with this one. If you have any questions, give me a call. All done.